Good evening, everyone. Thank you for joining us this evening on Understanding Risk and Volatility in Portfolios. I'm Crystal, the Community Manager at ProsperUs, your host for tonight. I've been in the banking and investment industry for over 5 years, and I'm now currently focusing on building the ProsperUs brand among the millennials. Let me start off by doing a quick introduction of our speakers tonight. We have Tim Phillips. We have our very own Tim Phillips, our content composer, who has over 10 years of content experience in the financial industry, including stints at Schroders and the Motley Fool. Next up, we have Jake. Jake is an Associate Director on the Discretionary Portfolio Management team at CGS-CIMB Securities. His primary responsibility includes managing discretionary investment mandates for the team, conducting quantitative research to uncover new sources of alpha, building proprietary strategic tactical asset allocation models, multi-factor equity strategies, and mutual fund selection models. Jake also holds a Bachelor of Business majoring in Economics and Finance from the RMIT University. He is a Chartered Market Technician, member of the CMT Association, and co-chair of the Singapore CMT chapter. Jake sits with the Private Wealth, and CGS-CIMB Private Wealth offers an integrated suite of financial products and personalized service to grow, preserve, and leverage your wealth. Private Wealth develops their own asset allocation models. They have recently launched discretionary portfolio management service to offer customized and standardized solutions to meet investment goals of clients. Allow me to share with you a little about ProsperUs. ProsperUs is a digital investment service launched this March for the millennials by the millennials. We aim to provide you with best-in-class service, and as part of our educational efforts, we have specially curated series like our webinars for millennials to gain more insights on investing. So with ProsperUs, you will not only learn how to invest, but also enjoy curated lifestyle experiences at the same time. Having a busy schedule and want to invest on the go? Check out our recently launched ProsperUs app on Google Play and the App Store today. Follow us on our social media like Instagram or Telegram to keep yourselves updated on the latest news. So without further ado, let's start tonight's session with a simple explanation of what risk and volatility are and why is it important for regular investors to know about this. Tim, over to you.
Thanks, Crystal, for the introduction. So I think I'm just going to share a slide which is going to pretty much just talk about what risk is versus volatility, because they're two very different things. I've only got a few slides, don't worry, I'm not gonna bore people. So yeah, sorry, let me go back and do the obligatory compliance, disclaimer. This is not personalized financial advice. And this is my own personal opinion. But when you look at risk and what is investment risk, if you look at the definition of it, it's actually the chance that an outcome or your investment's actual gains will differ from an expected outcome or return. So I think a simple way of saying it is, what is the risk of your investment actually maybe producing a permanent loss of capital where it goes down really, really steeply and maybe doesn't recover? So that's obviously a risk. So risk is something you have to take when you invest, because if you are investing, you need to take a bit more risk to obviously get a higher return. So I mean, I think Jake will go into the technicals of this in terms of the risk return curve, but as you go along the curve, you take more risk to get more of the return, right? Because you have to take more risk to get more return. But if you go lower down the risk curve, if you take less risk, obviously you'll get less of a return. So what is, sort of a risk-free investment is basically like a US Treasury bond, which is, they call it a T-bill, or it's a T-bill, like a 60-day or 90-day T-bill, is basically risk-free because it's backed by the US government. It's extremely safe. But then obviously it yields a very, very, very small amount. So it's, at this point in time, it's probably, I don't know, but it's, sub probably 0.5% or whatever it is. So it's an extremely minuscule return for the risk because it is effectively risk-free. So when you think about stocks, buying into a stock, you are obviously taking a bit more risk because it's not a bond. But it depends on obviously, AAA rated bonds and top bonds like the US and sovereign bonds, like, perhaps Singapore, the US, those are risk-free, but obviously the yield on them or the return you get is very, very low. So obviously that's forced a lot of people to go into stocks, but the compelling case for stocks is obviously risen with interest rates coming down. And so the need to take on more risk perhaps over the past decade is, has come to the fore. But effectively, when you do pick a stock or when you do pick an investment, you are taking on a form of risk, but it's just dependent on whether you see that risk as worth the reward that you're going to get later down the line in terms of your returns, right? So I think a lot of it is, there is some technical stuff to it that I think Jake will cover, but a lot of it is also your own investment risk appetite. How much are you willing to kind of put into certain investments, or how much risk are you willing to take on in specific names? So I've got just a couple charts here. So when you do actually pick a stock, if you are talking about risk, it's very different from volatility. So volatility to me is the chance, is basically the movement of the share price or the movement of an asset, right? So if it's volatile, you would say Bitcoin or Ethereum in terms of crypto, those are volatile assets. And then stocks like high growth stocks, technology stocks are very volatile. So they move up and down quite sharply. So, in one day they might move 20% or 10% if earnings are good, or they might fall if they disappoint on earnings or something else happens. So there's a lot of volatility. That's not necessarily a bad thing. I think that is just part of the market. That's just a feature of the stock market. So if you aren't able to deal with the volatility, then I think, it might not be a good idea to be buying those types of stocks. So you have to understand that. But if you are buying stocks, you do need to beat the S&P 500, right? Because that is the benchmark, especially in the US. So if you aren't able to do that, then you should probably just stick in ETF. It's easier and a lot less stress. But one point I wanted to make was, risk versus volatility. So how I see risk is investing into a company or maybe an industry that is in decline. For example, you have the left-hand side. I've kind of blacked out the names, but you can probably guess with some of the prices and the market caps here. But the company on the left has returned, has basically halved, or is nearly half where it was in 2007. Whereas if you look at the right-hand side stock, that stock is up over 30 times. So it's a very, really different type of stock. But the traditional investor would say the right-hand side stock is more volatile. So if you didn't know, the left-hand side chart is a stock chart for ExxonMobil, which is an oil company. And the right-hand side chart, you probably guessed, is Amazon, right? So Amazon is a volatile stock because it does move up and down quite aggressively. Over the past sort of 10 years in between, before it became a massive company, there was a lot of volatility. I think because it's so big now, there's probably less volatility, which we'll cover later. But if you had obviously invested in Amazon 10, 15 years ago, you would have been rewarded handsomely, but you would have had been able to tolerate the volatility in that name. Whereas in the left, I think the volatility isn't so bad, but as you can see, it's a terrible industry, and it's an industry in decline, right? It's a sector in decline. And so that's come through in the share price. So to me, the left-hand side stock, ExxonMobil, is much more risky. If I was investing, today, I would find that a much more risky stock than Amazon. So I think it also depends on how you view risk and volatility. But I'm happy with volatility in a portfolio. I think that's normal. Risk depends on your personal preference and where you see opportunity and perhaps what you define as risk as well. So I'll leave it at that and pass it on to you, Crystal, if you want to go on to the other questions.
Thanks, Tim. So based on your understanding of risk and volatility, right, do you think that smaller cap companies are more affected than mega cap companies?
Yeah, well, they tend to be because smaller cap companies Okay, so I guess I should just rewind for anybody who's maybe not aware. If you're talking about market capitalization, it's basically the value of a stock, right? So when we talk about Apple, it's shares. When you all add them together, they're worth $2 trillion, which is, obviously a massive amount of money. But what the liquidity or the money that it takes to move that kind of stock is huge, right? So for Apple to add 10% in a day, it basically needs to add $200 billion to its value, which is, humongous, which is bigger than a lot of companies in the US. Whereas if you're talking about a smaller cap company, like in the 10 billion range, or, 5 to 10, I mean, small cap now is actually the definition of what is small caps changing. It's going a bit higher just because of the market. But if you're talking about something that's maybe 5 to 10 billion in market capitalization, the amount that obviously they have to move, the share price has to move to say move up 10% is, say, a $5 billion stock would just have to add $500 million in value. So the incremental value is a lot smaller. And so that can attract inflows quite quickly. And that can also push up the share price, just because I think it's the volatility in large caps is so constrained just by the size, and then also ETFs that are tracking it. So there's a lot of sort of variable constraints, whereas investors or active stock pickers who are looking to beat the market, they're going to find opportunities in smaller cap spaces and smaller cap stocks. Same with like professional fund managers, retail investors, institutional investors. So moving with the market on the smaller cap side, it's a lot more volatile. Yeah, you wouldn't see Apple sort of fall 10% or gain 10% in a day. It's highly unlikely.
Okay, thanks, Tim.
Yeah.
So apart from that, earlier on you shared that there's a tool that everyone that is tuning in can actually rely on, which is the risk curve. So is there any other tool or chart that we can actually show the audiences tuning in to better visualize and understand the risk and return of each asset? Maybe Jake, you have prepared a slide or two, right, to actually show the audiences on this. Would you like to share it?
Yeah, that's right. Okay, can you see it?
Yes, we can see it clearly.
Okay, great. Okay, so over here, it's a very standard risk premium curve, where I'm sure you can find in textbooks, and you can always Google it. It's not a problem. So one of the key feature is basically the fact that as you move up the curve, you can see the risk reward tends to get higher. Okay. So on the lower end of this portion here is basically a very cash equivalent. So things like your money market funds, your FD are deemed as very close to cash. And of course, when you move up the curve, you will see things like government bonds, investment grade, and corporate high yields. They tend to return higher. Of course, naturally, you have to withstand higher volatility or risk. And of course, moving up, you have your large, mid, and small caps, which I will elaborate further in the next few slides. But of course, going back to where Tim mentioned, yes, I totally agree that volatility and risk are two separate things, and we shouldn't be confused with the two terminology. In fact, later on, I'll deep dive a little bit to share with you why volatility is not equals to risk, right? And of course, when someone, especially a new young investor or even a seasoned investor who's trying to build their portfolio, there are a couple of ways to maximize your portfolio returns. One would be through strategic asset allocation. You have to determine whether you want to do say 70-30, 70% equities, 30% fixed income, or do you want to do a more conservative portfolio construction by, let's say, overweighting fixed income because you're nearer to retirement age and things like that. So there are many different ways to grow your portfolio. Of course, the first most basic way is through asset allocation. The second way would be through tactical or sector allocation, which we can also call sector or factor tilts. This is when you intentionally tilt to specific sectors like technology, consumer discretionary, healthcare, trying to beat the market. So these are some of the things the more advanced investors can do. And of course, if you are even more advanced, you can be very specific about stock selection. You know exactly what you want. Straight away, you create a portfolio and you zoom in into all the names that are favorable to you, whether it's fundamentally strong or technically strong. So these are some of the things that investors can take advantage of. And these are the main strategies that all of us can utilize, right? Of course, the logic behind investing is very simple. We need to take risks because we will, if we want to have returns, we need to take risks. It's a very simple logic, right? If you want to have a business income, you definitely have to invest in the business, whether it's a cafe, whether it's an IT company. These are the business risks behind it. And investing in equities or fixed income, you are technically investing in an entity rather, right? That is in the marketplace, doing business, creating value, getting profits along the way, and hopefully you can be successful and grow into a mega cap like Apple or Google. So of course, the success rate of a small cap company growing into a mega morph, it's very low. This is the challenge of, I would say, investors all over the world, including retail and institutional. This is, I would say, the holy grail of investing, picking the next big thing, right? So moving on to the next slide. Okay, so we've seen that up there in the risk curve, naturally people are indoctrinated that small caps are more volatile or riskier. In fact, when we talk to a lot of investors, they would agree with that as well. But of course, don't take my word for it. Especially when I'm a little bit more quantitative, so I need to look for evidence. Right, so small caps more volatile, and this chart shows the 10-year volatility data of 3 ETFs ranging from big caps to mid caps and smaller caps. Right, so first on the chart would be this white line over here, IVV. IVV is iShares Core S&P 500 ETF. So you can see over here it has about 14.9 or 15% volatility. And the next in line is this orange, IJH. It stands for iShares Core S&P Mid Cap ETF. And you can see that volatility is 19%. And the third one is IJR. This is an ETF for US small caps. And you can see the volatility is at 23%. So it's very simple to see that it's almost twice as volatile as the big caps over here. And of course, it's very evident that these small caps are definitely more volatile or riskier than big caps. So this chart basically looks at the 21-year annualized return of the earlier ETFs that we mentioned. And of course, the question is, since small cap carries higher volatility or risk, does it necessarily translate into better returns? And we can see over here, the IVV actually returned 7.4% annualized, and the mid cap returned 9.65%, and the small caps returned 10.39%. So according to convention wisdom or things that we learn in school, the small cap premium seems to hold well over a 20-year time horizon. However, this problem starts to show up if we dig any deeper. And this slide over here shows a shorter time frame, and it paints a different picture because you can see that the big caps actually returned 16.79%, beating the mid and the small caps. So what is happening behind all this? I would say is a subject by itself. There's a lot of debate within the investment community. Nobody has a firm answer, but a lot of new research is it's challenging the conventional wisdom. It's small cap premium losing its efficacy. Well, I would say maybe yes, maybe no, but definitely one plausible cause behind this is due to the indexation that is happening over the last 5 to 10 years. More and more markets are, or rather more and more investors are closely following certain indexation. So the current small cap premium over large cap, it's not quite stable. If you ask me, this relationship is not quite stable. Of course, we believe that if you want to build a portfolio, especially if you're a new investor, you definitely will be looking at using index ETF or mutual funds. So you have to build a core portfolio first, and building a core portfolio is basically like building the foundation of your house. So that means you need to lay down the foundation, because without it, you cannot build anything up. But for the more advanced investors, you would start to, or you would rather need to start making decisions whether you want to do tactical tilts, choosing what to underweight, what to overweight, especially, for example, a geographical region, which country, which sector, which industry, and coming down to the market caps that we are talking about here. Are you going to overweight big, mid, or small caps? And you can even think about like single names that you may be interested, like Tesla, Google, things like that that can boost your overall portfolio performance. But of course, you have to avoid making excessive bets towards something simply because you think it will give you better absolute returns. Because most professional investors think from a risk-adjusted basis, meaning you have to make sure that your portfolio is properly in line with the risk that you're taking on. And of course, I don't just mean volatility, meaning permanent loss, right? I believe some names have been a big disaster or a big blow up over the years. And if you are overly invested or overly, I would say, hands in, or what's the proper word for that? Or for nothing, then I think you're in trouble, right? So one of the key message I would have to tell investors is you have to match the market first before you can try to beat it. That's very basic. It's like learning how to walk before you can start running. So do not be overly impatient, right? Take baby steps towards achieving your goals. Do not try to beat the market if you haven't even have the ability to match the market performance. Okay, so Crystal, I think I'll stop here to...
Sure.
Yeah.
Thanks, Jake.
Yeah.
Yeah, so moving on, right? Do you think that there are some industries or sectors that are more volatile than each other? Like, let's take the technology sector as an example, like how the tech sector was actually booming, and then there was a crash earlier this year.
Okay. Okay. So, okay, technology is something very permanently driving behind industrial revolutions. In fact, technology right now we're in the fourth wave. The first wave, second wave, and third wave are all key driving forces of changes in how consumers spend, how economies reshape themselves, and a lot of things are actually relying on changes in technology or improvement in technology. Whether it's let's say your new iPhone, or whether it's the way we treat certain illnesses, all these are technological advancements, right? So it boils down to application in the various sectors or industries that will further grow that particular industry. So if you ask me, it's the backbone of all modern civilization, right? So therefore, technology has always been the key focus of a lot of fund managers, especially if you look at a lot of mutual funds or index ETF. Technology is usually the best performing for persistent period of time. But of course, yes, there are periodic sector rotation happening in the marketplace once every 6 to 12 months. But all these are basically mean reversion to a more reasonable valuation levels. Of course, there are some sectors I would like to highlight because those are very statistically significant, meaning besides technology, there are sectors like consumer discretionary and communication services, because things like your Apple, your telecommunication services, this falls within communication services. So this sector actually has been carved out from technology, right? So these are the key drivers, and healthcare is something that one shouldn't neglect, because healthcare is also one of the pillars of outperformance if we are looking at beating the market or getting better performance for your portfolios. So these are the three sectors that will also do very well besides technology. And I would like to highlight to investors to pay special attention to. Of course, there are some short periods or short bursts of outperformance from other industries on and off, but from a long-term perspective, these are the ones that you want to overweight in your portfolio. Of course, many companies like Apple, Google have emerged as tech giants because their ability to stay ahead of the game. So investors who are looking to capitalize on growth, right? Technology is always growing other sub-industries or other sectors as well. So in order for us to understand the risk that comes along with this very special sector, right? Very special key driver of civilization. This tech sector is definitely something that one should not neglect. And of course, yeah.
I would add also, to Jake's point that technology has performed so well because it's so disruptive and innovative, and that's really driven earnings, right? And at the end of the day, a lot of stock prices and share prices move in relation to how well the business is performing and how strong their earnings growth is. And the earnings growth from the technology sector is, tends to be superior quality, and it tends to be faster as well. So I just wanted to highlight that as well, which is I think an important point to make. Yeah.
Correct. Especially if you look at the fundamentals of most of the tech companies, they are showing stronger balance sheet. They are showing very strong growth, very good cash flows compared to some of the sectors that are not so favorable from time to time due to whether they are economically sensitive or they are cyclicals. So yeah, tech is it deserves a special mention or a special place in everyone's portfolio. But of course, the big question mark is, are we going all in on tech? Because it's very volatile. It can be 20% up year one and 20% year down year two. So these are some of the questions we all have to ask ourselves.
Yeah.
Yeah.
No, definitely.
That's right. And of course, this is a particular example or a classic case study that I want to share with everyone, because we all know that it's volatile. We all know that volatility may not equate to risk, but it can also blow up in our face. This is a good example because almost 20 years back, I was actually in telco industry. I was a buyer. In fact, I was part of the team who brought in BlackBerry into Singapore. So BlackBerry has a special place in my heart. And I would say one of the unforgettable stocks that a lot of investors have been caught, it happens to be BlackBerry. I've seen a lot of people holding on to BlackBerry, and very high net worth people are suing the banks because of some structured products that they've been structured around. And not just that, a lot of people who believe that, hey, whether it's Nokia or BlackBerry was the next best thing to ever own, well, it's back to square one, right? It literally brings you back to earth because they cannot mutate or rather they cannot stay in the game. It was a top player in their segment for a long while, and they have great market share, but because they got I would say complacent, and they failed to follow the trend, because it's very clear that being in the tech space, you really need to be on top of your game, right? So BlackBerry is one classic example. It went to $148 in June 2008, and it was valued at $83 billion at that point in time, right? And of course, the GFC kicks in, it all ended. Yeah.
So got iPhone, right? It got iPhoned. I mean, it's the iPhone basically disrupted.
Correct. Correct. You have new competitors, you have new entrants into the marketplace. All these are correct. All these are ongoing, right?
Yeah.
If you're strong, naturally attracts competitors, and if you're not, I would say, if you're not really capable to be at the leading pack, then you will lose your edge, and therefore competitors will simply take your place and wipe you out. Yeah. So this naturally means that volatility, or rather what you can see here is volatility, it may not necessarily be permanent loss, right? Technology is volatile, but it's definitely not meaning your leaders will lose ground. And BlackBerry's fall from grace is partially due to the fact that they lost to the competition and they're being replaced, right? Of course, in the tech space, there are a lot of shifts like that, and that creates risks for this real risk as a permanent loss, right, for technology companies. So of course, with that, as the saying goes, out with the old and in with the new. And the only beneficiaries to all this technological advancement is actually consumers like us, because tech companies are constantly at risk of being left behind if their R&D fails to keep up with the changes in the market. And of course, the tech space is super competitive. And because of this competitive nature, we need to make sure that as an investor, we need to really have a disciplined approach to our investments in the tech space. If you're investing in a tech ETF, I think it's fine because the ETF will make the necessary rebalancing for you. But if you're doing specific stock picks, be very careful because it tends to blow up in your face if you're not careful about that.
Thanks, Jake. Yeah. Thanks, Jake, for sharing. So back to you, Tim. Do you have any suggestions on how investors can balance their portfolio between assets, which are more volatile and less volatile?
Yeah, so I mean, going to Jake's point, I think it's important to have quality in your portfolio. Volatility is different, right? That's just the share price movement. So I think you can utilize what a lot of maybe professional fund managers kind of think of in terms of a barbell approach. So if you think at one end, you have a lot of sort of high quality blue chip, sturdy companies that are not going to get disrupted. So let me make that clear. They're good quality companies, maybe in the retail space or, banks or, REITs, for example, that give you a good income and a good yield, but are strong and continue to grow. And at the other end, you have, high quality growth companies, which, would tend to be technology, maybe healthcare, maybe some consumer discretionary as well, communication services, as Jake pointed out. So I think the balance is up to you on your own risk appetite and how much you can stomach volatility, because some people are okay with their portfolio falling 30-40% in like a year or in 6 months, but some people are not okay with that and they can't sleep at night. So I think it depends on what helps you sleep at night, what allows you to be comfortable, right? Because you do have to remember, no matter what happens with the share price. I mean, BlackBerry is an example of disruption, and that's permanent capital loss. But if you are following a company closely, or if you're an ETF, a NASDAQ ETF, and it falls, that's not a reflection of any specific company, right? Because it's just a movement of the market and it will come back eventually if you're thinking of an ETF. But it also applies to a company. I mean, you don't make a loss until you sell. Like, you have to remember that. That loss is just on paper if you have a loss. So if you have confidence in the business, the company, the sector, and their place in that sector to keep growing, share prices don't always reflect the business, right? But obviously, if they are structurally deficient, or if you really feel like the company's suffering and it's going to continue to suffer for a long time, then that might be a time to think about your position. But I would say balance it out between those two, high quality growth and then high quality sort of more blue chip income generating companies, and then figure out what balance you want between those two. Yeah.
Okay, thanks Tim and Jake for sharing so much insights tonight. Before we open up the floor for any questions, we have Andre, our wealth wingman, who will be taking you through our platform. Andre, over to you.
Hi, good evening, everyone. Thank you, Crystal, for the introduction. My name is Andre, and I'm the wealth wingman here at the ProsperUs team. So I'm going to be taking you through the platform very quickly to show you some of the features in line with what was actually discussed between Jake and Tim. Crystal, can you see?
We can see. Yes, okay, we can see your screen.
Okay, so this is the Boost platform. This is one of two platforms that we actually have available here on ProsperUs. So a couple of things that I'm going to take you guys through would be the screener. As you can see, this is pretty much a stock screener, but it's not just limited to stock. So if you actually click on the drop down here, it actually shows you all the other products that we offer on our ProsperUs platform as well. So what you can do is then add filters. So if it's country specific product that you're looking for, or industry specific, all right? So if you can actually click on the different industries previously mentioned were some tech specific, so information technology, all right, services. You can actually use that as a filter as well and apply. So then this list would actually automatically update. So you can add more filters as you go along. As you can see, the different filters that you can add to the list as well. So then you can also sort by the different market capitalization, price change, and whatever, and that would actually show accordingly. So you can do it in ascending or descending order. So over on the right here, you can see that it's a product overview. So as you click on any of these stocks, the right side would pretty much sync to whichever product that you've highlighted. So then what this product overview does is it shows you a brief summary, okay, as well as news and a brief general information on the stock that you've highlighted. So it shows the market cap, price, earnings, as well as the sector. All right. We also do have some fundamental numbers here available. If you are a technical trader, you can actually click on these charts and do your own technical analysis as well. All right. Okay, next up will be the account tab here. So just want to give you an idea of how the platform can actually track the performance of your portfolio. So it actually shows you top gainers, top losers, and the cumulative P&L of your portfolio as well. And in terms of risk management tools, so if you click on the returns here, you can see on the statistics, all right, the max drawdown, standard deviation, Sharpe ratio, and even Sortino as well. So these are some features on the platform that will help you in the management of your portfolio. So I think that's pretty much it. I'm going to hand it back over to Crystal now.
Thanks, Andre. Let's take in some questions. Today, we'll be doing this Q&A a little bit different. So if you have any questions and would like to actually speak up, please click on the raise hand button at the bottom so that we can actually unmute you. Alternatively, right, for shy viewers, you can still type your questions to us via the Q&A button. Okay, maybe let's take a look at the first question that we have. Is Sharpe ratio a measurement of risk? How do we make use of this matrix? Jake, would you like to answer this?
Yes, correct. Yeah. Yeah, correct. Sharpe ratio was actually devised to measure the risk-adjusted returns for mutual funds. And of course, we can use it to measure any investment strategies, especially long-only strategies, in this case, ETF as well. Or we can use it to measure our portfolio risk-adjusted returns. Of course, one have to take note is the fact that we are taking the returns less of the risk-free rate divided by the volatility. Of course, then again, volatility is not actually the best measure for risk or permanent loss. But it's good enough to give you a sense of how risky or how volatile your portfolio is. Of course, you can use it to measure mutual funds, your portfolio, your ETFs, and to a certain extent, some investment funds that could be private. You can use it as a way to measure them. Yeah, so this is one of the common way, and it's very useful because it's very simple to measure. Of course, there are other methods like max drawdown. If you ask me, I think a better measurement of risk is max drawdown. That means if you look at a 5 to 10 year period, how often this particular stock or sector or this portfolio goes into a drawdown. And this will not only give you a sense of how much it can decline in a correction or in a bear market, but also how it can recover, right? Things like that. So if it can't recover, then you see a prolonged max drawdown. And if the strategy or the investment is robust, it can recover fast. And of course, the max drawdown is usually much shallower than when you're measuring between two investment funds or portfolios for that matter. Right. So
Thanks,
of course,
Jake.
one more ratio you can also use would be your Sortino ratio. is commonly used as well. This is a better measurement of risk because Sortino ratio actually is very similar to your Sharpe ratio, but it actually use the volatility when it's below the mean during a decline. So Sortino ratio is a better measurement for risk compared to Sharpe. But Sharpe is good enough to give you a broad sense of how volatile your portfolio is. Yeah.
Okay, thanks,
Yeah,
Jake.
thank you.
We have a attendee who have raised their hands. Maybe I'll allow this person to actually speak up. Hi, YL. Hi, YL. Are you still there? Would you like to unmute yourself first? Okay, maybe we will go to the next question first. Why would tech go 20% down in the second year? Tim, would you like to take this question?
Sure. I think this is related to what Jake just brought up.
Yeah, correct.
Yeah.
Because sorry.
You go
yeah, because the standard deviation for or the volatility for tech is around 20%. So that means we are expected at any point in time, at any given year, this particular sector or this particular stock, if you're looking at 20% standard deviation, that means you can be, let's say your average is 10%, if your standard deviation is 20%, so that means it's 20% up or below your average. So it can be 30% up or say negative 10% down.
Yeah.
Right. Yeah. So that is the dispersion of your returns.
Yeah, okay. I would say on a growth stock basis as well, like that kind of movement, even in like a day in reaction to earnings, is like quite common, like up 20% or even down 20%. So you have to be prepared to deal with that volatility if you're investing in individual stocks. I think Jake's point is a bit more maybe towards ETFs and a basket approach. Yeah.
Yeah, correct.
Okay. Let's take a look at the next question. One way to value stock is market cap or GDP. Why is that so? And if it's international companies like FB, does it mean that we should divide by world GDP rather than US GDP?
Okay, maybe I'll have a sort of go at this first. Well, I think this is actually a Warren Buffett measure, right? He's made famous kind of valuing, and I think it's been a good measure for past crashes. But there's obviously a big debate going on between people who are bullish on tech now and obviously the old school of thought about tech valuations. But I would say, I guess from someone who's a bit younger and has obviously maybe got more positive outlook on tech, I just think also GDP it doesn't take into account a lot of intangibles. It doesn't take into account a lot of services. It doesn't take into account a lot of IP and intellectual property. So I think a lot of what we consider traditional GDP is also not standardized throughout the world, right? So something like a China, they estimate their internet economy to be, a multiple the size of what they're estimating it to be within its own GDP sort of numbers. The same thing goes for, America, right? The US just has a massive internet economy, but whether you're an economist and whether you're, really in depth in the data, how much of that is actually being captured by GDP? Like, I'm not so sure. And I'm not that confident that a lot of the productivity gains or a lot of the actual sort of economic value is being captured in GDP. So personally, I wouldn't use that now, especially in a world where there's so much intangibles. I mean, maybe back in the day when Warren Buffett was using it, we had sort of factories producing goods, and it's very, very much capital intensive. Nowadays, it's not. So I think the way that the global economy has changed over, say, the past decade or 20 years means I'm not sure if that model is applicable to today's environment.
Thanks, team.
Right. That's right.
Would you like to share anything to add on?
In fact, I personally don't use it, and I don't think it's appropriate to use it because there's a lot of research out there that really suggests that market movement has got nothing much to do with GDP actually. So that's a wrong input to use for valuation. Of course, Buffett used it last time. It's not appropriate now, and one of the key inputs we need to use for whether valuation model or any sort of indicator that we need to rely on needs to have a strong correlation with the markets instead of being tied to the economy. In fact, if you look at GDP growth, if you tie GDP growth to how US markets move, it's totally irrelevant, right? US GDP has been dropping for the last 20 or 30 years. But why is the US market doing much better than the rest of the world? Right? It just simply don't make sense. So that kind of assumption or the kind of reliance on GDP figures or as input, I think it's not appropriate for now. Yeah.
Thanks, Jake. Can we take a look at the next question? A lot of growth companies are super overpriced regardless whatever valuation model, but yet they keep going up. If I buy, I fear if their support will crash anytime because price makes no sense. But if I don't buy, I watch them go up every day and felt left out. Any advice on this?
Okay, I think I actually spoke about this earlier with like the team, actually, the ProsperUs team. Is I think valuation is very subjective in terms of what people are willing to pay for a stock. There is obviously the old school of thought, as I said, we have a few sort of more traditional investors who think that things should be priced on, price to earnings. And if they don't have any earnings, then you can't invest in them because there's no point to that. They're loss making, so don't invest. So that example, if you applied to sort of Amazon over the past decade, you would never have invested in Amazon, and you would have missed out on whatever, and you would never invested in Tesla. Not to say that you need to go out and buy these types of companies, but obviously everyone wants to find that next big hit, as Jake alluded to earlier. So I think you just need to really understand the fundamentals of the business, but you also have to benchmark the price. I think nowadays with growth stocks, it's price to sales rather than price to earnings, because a lot of them are not earnings. Yeah, they don't have earnings, or the earnings are really far out into the future. So you have to think about where it's going to be in sort of 5-10 years. But if they have dominant positions in their sectors and they're going to keep growing for the next 5-10 years, then I think buying that stock now at all times highs is a mental block you have to get over if you believe in the company. But if you're just going to hold it for 5 months, don't be surprised if it falls 20%, right? Or 30%. If you're going to hold it for 10 years and you really believe in the company, then I think that's when you'll start to see the gains that you expect to come through if the company performs as you expect, right? So every time they release earnings or they come out with their numbers, they'll guide for the upcoming quarter and the upcoming fiscal year. If they outperform on guidance, or if they beat and raise by a lot, then they will get repriced and they'll get re-rated in terms of their valuation. So the valuation right now might be sort of 30 times sales, price to sales, but maybe by next year that would have come down to 20 based on what they're guiding on, right? So I think they catch up with the valuation if they continue to perform at that level. So you have to really understand where the business is, and also the sector's sort of average But I don't think it's any coincidence that obviously the better quality companies trade at a premium in terms of, price to sales. That's just because the better quality companies deliver. So if you're going to say, I'm not going to pay 50 times sales because this company, or 40 times, I'm not going to pay anything above 20 times, then you might miss out on some really, really great companies that are priced at a premium because they're quality. I mean, from my experience, quality costs money. It's expensive. So if you want to buy something at 2 times sales, you can go buy like AT&T or like, Verizon, but you're probably not going to make any money on that over 5 years or 10 years. So I think it's a real like mental dilemma, because you don't want to pay too much for what you think should do well, or, you don't want to pay too much. But I think sometimes it's better to get out of the mental headspace of the valuation, unless it's something crazy like a snowflake at, I don't know, like 100 times sales or something insane, right? If you think about the averages within certain niches, buying in an all-time high doesn't mean it's not going to go higher, right? But you have to be willing to hold and be patient. That's what I would say.
Thanks, Tim. I think we have a few more questions. Maybe we can take a look at the next question. How about shorting? Is it riskier? Could we make more money shorting rather than going long?
Jake, take that. Jake.
Okay, let me take this. In a nutshell, shorting is not easy. A lot of market neutral funds are not doing well, simply because of the fact that the broader market tends to move up 60% of the time. The rest of the 40% of the time, it's either sideways or in a correction. And the correction, or you can call it correction or bear market, it typically lasts or takes about 15% of the time. So if you're trying to be a market neutral person, that means you are 50% long, 50% short. You are missing out a lot of opportunities, and you're dedicating a lot of resources to go on the short ideas, because you have to find those ideas, right? Of course, if you look at a lot of long short funds, some of them, or rather most of them, are not doing well. Only a handful of them are doing very well because of the idea generation or the stock selection in their books. But that being said, actually, for the long short funds, if you ask a lot of them, they will tell you the short side of the books are not really making the money. The long side of the books are making more money than the short side. So it tends to neutralize each other in that sense. But of course, there are still some notable short sellers out there who dedicate their time to finding very good ideas to short. I'm not saying it's impossible, but your ideas need to be good. But bearing in mind, shorting, it's limited downside, because a stock that is trading at $100 can drop to zero at best, but $100 stock can go up to 1,000, 2,000, right? It's unlimited upside on the long. So short, not recommended for most people who cannot even master taking long positions. That's the easiest way to make money, if you ask me, from a trading perspective, and even from an investment perspective. There's no reason for you to short. If you're a bit more savvy, yes, you might want to take some tactical shorts to to hedge against your downside when your portfolio is huge. In fact, this is what a lot of hedge funds do, a lot of fund managers do, just to protect the downside. But you never do a full hedge. You never go into a full short. It's always just protection.
Okay, thanks, Jake. Let's take a look at the next question. Is tips provided by CGS, I think, CGIS, a good alternative to buy ETF sector? What amount will be a good start and as part of portfolio?
Yeah, tips is a product by our CFD. And I would say, why not if you have account with them, right? Because I've seen some of the thematic ideas over there. It's pretty good. Yeah, the only thing is you have to ask yourself, it's leveraging up using CFD products suitable for you. Yeah. because with leverage, you have more volatility. You have to set aside more margin for margin calls in the event you're wrong, or in the event you are using too much of your capital tied up, not having any buffer for any movement or any margin call that comes along with your exposure, because you are taking, I believe, easily 5 to 10 times leverage. So that's quite a fair bit of leverage to manage, because most of the time we are only using about 3 times leverage for the professionals.
Okay, thanks, Jake. I think we have one more question, right? One last question, or can we take a look at that? Why some high growth cash stocks, their price doesn't go up, but for some stock lost big money, price still go up? What is the logic?
Okay, so I think this means high growth cash stocks. Does that mean they've got a lot of cash, like they're earning profits, I assume? I think if that's the question, why their price doesn't go up, but maybe some that are losing money, I assume growth stocks, their price still goes up. What's the logic? So I think it's more about the discounted cash flows, right? If you're thinking about growth, it becomes much more attractive in a low interest rate environment, because you're thinking about the cash flows further out into the future, and you're buying into the business, cash flows into the future. So these kinds of stocks, if they have good businesses, if they have large TAMs, which is a total addressable market, and they're growing, and they continue to obviously post earnings that beat or raise or beat expectations and raise the guidance, then I think that means that they will continue to perform well. So you've kind of seen that with the whole pandemic rebound. It's gone back into tech because everyone's been super bullish on technology. You've seen a bit of a reversal of that because valuations, obviously, I think it became frothy. So they went back into your traditional value, which is, energy and industrials. And they might be the ones that have maybe strong balance sheets, or they might have solid businesses now, but maybe their growth isn't as high. So I think there is there's understanding where you're excited about a business. I mean, for most people, if you're seeing excitement on growth and innovation, it's usually in technology. If you are seeing businesses that have a lot of cash, although to be honest, companies like Microsoft and Amazon and Apple, they have loads of cash and they're growing really, really fast for companies that size as well. So they're kind of saying that big tech, at least at that level, is maybe even a defensive sort of position in portfolios if there's volatility or sell-off. So I think it basically boils down to the fact that interest rates are low and people are willing to take on more risk to get a return out into the future.
Thanks, Tim. I think we have 2 more questions to address. I would like to know your opinion regarding the tech stocks movement in Singapore compared to Indonesia, because both stock exchanges experience the same hype. Tim or Jake would like to actually address this question?
Tim, don't mind if I go first?
Yeah, go for it. Go for it.
Okay. For all investors out there, investors and traders alike out there, the markets tend to look at US for leadership. If you want to be a trader, especially, you have to look at, or you have to keep track of how the sectors are doing. In fact, that's a basic thing that most traders will need to do, especially the professional ones. You have to see where the capitals are flowing towards, which sectors. And of course, if you look at the last 3 months, capital is flowing into low volatility, high dividend yield, and healthcare. So just by interpreting the movement over the last 3 months, you can see there's a rotation into more defensive sectors. Prior to that, you can see, yes, all the optimism in the markets were quite prevalent after COVID, and that's when you see people buy into high growth sectors like tech and other stuff, and they tend to rotate away, and that's when you see a bit of mean reversion and rotation into the value side of the market. So we have to keep track of where these flows are moving so that we can better anticipate our own local movement. The local markets, even for other regional markets like Hong Kong, tend to follow suit US. So if you're a trader, you definitely need to pay attention to the US market. You need to do your homework. Well, which sectors are moving and which are the ones that are not, right? So you have to measure relative momentum, and you have to see where the relative strength is, so that you can be better prepped and screen out names that are potentially going to be on the right side of the game.
Yeah, thanks, Jake. I think we have one last question from the floor. Can we just take a look at the last question? What are the major risks in US market now?
Okay, maybe I'll go first on that. I think one of the major risks is actually the sort of inflation. Obviously, if it's not transitory, there's a lot of talk about inflation being transitory, and talk of it's the Federal Reserve saying that this is only going to last maybe like 3, 4, 5, 6 months, and then it will return back to normal. If it doesn't and it consistently trends higher, then I think that's going to change the timetable for sort of rate hikes further out into the future. And I think there's obviously a symposium going on this weekend for the Federal Reserve at Jackson Hole, where I think they will discuss the tapering timetable for bond purchases. But I think that's been pretty well signaled by the Federal Reserve. So I don't think there will be any short-term volatility from the Fed, but I think it will come through maybe with inflation. Outside of the economic factors, I think there's all the usual things like the Delta variant and what happens there. Is it going to upend any economic recovery? And you're seeing shortages in obviously a lot of components and supply chain disruptions and wage shortage, labor shortages, which is driving up wages as well. So there's wage inflation. So I think there are quite a few things related to inflation to watch out for. And obviously, the Delta variant and how that plays out as well. Yeah.
Thanks, Tim. That will be the last question for the night. Thank you for joining us tonight. For any queries, right, you can actually reach out to us via email at hello@prosperus.asia. Please do help us to actually fill in the survey form to help us understand you better. For those on Zoom, the survey form will actually pop out after exiting today's session. And for those who are actually on Facebook, right, please do scan the QR codes on the slide shown. And we hope to actually see you in our upcoming webinars. Thank you and good night.
Thanks.
Thank you, everyone.
Bye.
Thank you.
Bye.